Welcome to One Touch Professional School. I trust we are all doing well. We are most grateful to the Most High God for the gift of life and for the opportunity to be counted among the living. We continue our discussions on Introduction to Management Accounting. Today we are looking at chapter 15, and the focus is on standard costing and variance analysis. Standard costing and variance analysis. What is the expectation? Now, we are to know what is standard cost, okay, or the standard cost of an activity. And now you know that as a business that you plan for the forthcoming operation or activities. And therefore, the plan may differ from the actual. Okay, so it is likely that the actual activity may, in terms of cost, maybe higher than the planned or budgeted, or the budgeted may be less than the actual. Now, we'll then try to investigate what is causing our planned activity to be different from the actual. Okay, good. So this serves as a form of a control measure, okay, to assess the performance of a company and its managers. All right, good. So that is basically what we are going to look at under standard costing and variance analysis. Okay, good. Now, standard costing. Standard costing involves the establishment of predetermined estimates of cost of products or services, the collection of actual costs, and the comparison of the actual cost with the predetermined estimates. The predetermined costs are known as standard costs, and the difference between the standard costs and the actual cost is known as a variance. Okay, so as indicated here, standard costing involves the establishment of predetermined estimate of cost of product or service, and the collection of actual costs and the comparison of the actual cost with the predetermined estimate. And here, the predetermined estimates are referred to as standard costs. Okay, and the difference between the standard cost and the actual cost is known as a variance. Okay, good. So some predetermined costs may be established. The company will estimate the cost that they will incur in producing, say, a unit of a product. Okay, good. And they will look at actual costs that may be incurred in producing the product or rendering the service. Okay, good. So the predetermined estimate will then be compared with the actual cost, okay, to find out what is causing the difference. Is it that the predetermined cost or the standard cost is more than the actual, or is the actual more than the standard? And then we try to investigate what caused the actual to be different from the planned. Okay, good. Now the process by which the total difference between standard and actual results is analyzed is known as variance analysis. So variance analysis refers to a process by which the total difference between standard and actual results is analyzed. Standard costing is used to value inventories, prepare cost budgets for production, and provide control information. Control information. So we can use standard costing to value inventories, to prepare cost budgets for production, and to provide control information. Control information in the form of the variance analysis, because we try to know what is causing the difference between the planned or the predetermined cost and the actual. Okay, good. Good. And so what is a standard cost? What is a standard cost? We looked at standard costing. Okay. Now, what is standard cost? Now, a standard cost is an estimated unit cost built up of standards for each cost element. A standard cost is an estimated unit cost built up of standards for each cost element. Okay, good. So we know the cost element. We know that the cost element are material, labor, and what expenses. So when we talk about the standard cost, we are looking at the estimated unit cost of a product or a service. Okay, good. Now, a standard cost is an estimated unit cost. Okay, a standard cost may be based on either marginal costing or absorption costing. Okay, good. Because under marginal costing, we looked at how to determine the cost of a product. Okay, by using the variable costing approach, where only variable costs of production are factored into the product cost. Whereas under absorption costing, both variable and fixed production overheads are considered as part of the product cost. Okay, good. Now, so we are saying that for a standard cost of a product, an organization may opt to use any of the approaches, either marginal costing approach or marginal costing technique or the absorption costing technique. Okay, good. Now, standard costs also provide an easier method of accounting since it enables simplified records, okay, to be kept. Standard costs also provide an easier method of accounting since it enables simplified records to be kept. Once estimated, standard costs are usually collected on a standard cost card. Okay, good. So once we estimate the cost of a product, then those costs are collected, okay, on a standard cost card, which will show, okay, if you want to produce just a unit of a product, we will need so much materials, we will need so much labor, the direct expense of so much will be incurred. So that will be built into what is called a standard cost card. So a standard cost card will show you the various elements of cost that goes into the production of a product or the rendering of a service. Okay, good. Good. Now, what is the uses? What are the uses of standard costing, or into what use can we put standard costing? Okay, so the uses of standard costing. One, to value inventories. It is an alternative to the FIFO and average cost as a method of inventory valuation. Okay, good. Two, to budget production costs. Standard costing can be used in the budgeting. Okay, can be used in budgeting. Okay, for production costs. So we say that when a standard per unit of a product has been established, budgeting production cost becomes fairly straightforward process because we know the cost for one. So if you depend on the number of units that we want to produce, we can easily determine. Now, to budget production cost, okay. Sorry, that's a repetition of the first one. To evaluate managerial performance. Standard costing can be used to evaluate managerial performance, because if you have indicated to incur so much on a product and the actual production takes place and the cost differs from the actual, either it is more than or less than. Now we'll be able to use it to evaluate the performance of management. Are they doing well in terms of controlling costs? Are they doing well in terms of maintaining costs within the acceptable standard? Okay, good. Now, 4, to enable the principle of management by exception to be practiced. Now, a standard cost, when established, is an average expected unit cost. Because it is only an average, actual results will vary to some extent above and below the average. Only significant differences between actual and standard should be reported. So we are not saying that because we have budgeted or because we have estimated the cost to be incurred, then we expect the actual cost to be exactly the same as estimated. No, it is an estimate. It's bound to change. However, if the variance is huge, if the variance is huge, then there is the need for us to investigate what caused the difference. So that's why we look at management by exception. In the case of management by exception, we'll be looking at significant variances and try to find out what caused that huge variance. Okay, great. To provide a prediction of future costs for use in some decision-making situation, to provide a prediction of future costs for use in some decision-making situations. Okay, good. And to motivate staff and management by providing challenging targets. Okay, good. And to provide guidance on possible ways of improving efficiency. Okay, because the standard is there, so you must try as much as possible to live within the standard, to make sure that you do not go overboard. Okay, great. So these are some of the uses of what standard costing. Where should standard costing be used? Okay, now standard costing is most suited to mass production and repetitive assembly work, where large quantities of a standard product are manufactured. So in a situation where there's mass production or the production is repetitive in nature, okay, good, where large quantities of standard products are manufactured, good. Although standard costing can be used in a variety of costing situations, batch and mass production, process manufacture, jobbing manufacture, where there's standardization of parts and service industries, if a realistic cost unit can be established, the greatest benefits from its use can be gained if there is a large amount of repetition in the production process, so that average or expected usage of resources can be determined. It is therefore most suited to mass production and repetitive assembly work. It is not well suited to production systems where items are manufactured to customer demand and specifications. Okay, good. So we now know situations where standard costing may be applied. Now let's look at the standard setting process. How an organization may set a standard. Okay, good. So we know that we said that it's about accumulating cost, about the cost element. Okay, and for cost element, we know we have material, we have labor, we have expenses. We know the expense can be direct or indirect. Okay, good. All right. So let's see. Material cost. Now, direct material cost per unit of raw material will be estimated by purchasing department from their knowledge of the following. Okay, so to set the standard based on the purchasing department's knowledge in purchasing, okay, or on the following, they may use it to decide, okay, what the standard material cost should be. So say they'll look at purchase contracts already agreed, pricing discussions with regular suppliers, forecast movement of prices in the market, the availability of bulk purchase discounts, the quality of material required by the production department. Okay, so these are some of the things that the purchasing department will consider, factors they will consider in setting direct material cost per unit of raw materials. Okay, they will look at purchase contracts they have already agreed. Okay, pricing discussions with regular suppliers, then forecast movement of prices, that will look at inflation in prices. Okay, we will look at the availability of bulk purchase discounts. Should they buy in bulk? Will they get some discount? Then the quality of materials required by the production department. These are some of the factors an organization will consider in setting or fixing material costs. Good. Now, the standard cost ought to include an allowance for bulk purchase discount if these are available on all or some of the purchases, and it may have to be weighted average price of different prices charged for the same product by alternative suppliers. A decision must also be taken as to how to deal with price inflation. Standard costing is therefore more difficult in times of inflation, but it is still worthwhile. Okay, now usage and efficiency variances will still be meaningful. Inflation is measurable. There is no reason why its effect cannot be removed. Okay, we say that inflation is measurable, and there's no reason why its effects cannot be removed. Standard cost can be revised so long as this is not done too frequently. Okay, good. So let's look at labor costs. How can organizations set a standard labor cost? What factors would they look out for in setting the standard labor cost per unit? Okay, good. So direct labor rates per hour will be set by reference to payroll and to any agreement on pay rises. Okay, on pay rise with trade unions representatives of what? The employees. So we have the labor rates. So now we know Ghana, we even have our labor, okay, good, the labor ministry, where they will look at some of these things. Okay, good. So they say that to set a standard labor cost, the direct labor rates per hour will be set by reference to pay rule and to any agreement on pay rise with trade union representatives of the employees. A separate hourly rate or weekly wage will be set for each different labor grade type of employee, either different grade or type of employee, and an average hourly rate will be applied for each grade, even though individual rate of pay may vary according to age and what experience. Okay, good. Similarly, similar problems to those which arise when setting material standards in times of high inflation can be met when setting labor standards. Yes, so as inflation, okay, as there are price fluctuation, okay, we need to also factor that in determine the labor rate, how much to pay labor per hour or per day. Okay, we need to factor all these things. Okay, good. And we know that when it comes to labor, there are various labor unions who speak for their members to make sure that their members are not shortchanged. Okay, good. Now let's look at material usage and labor efficiency. So in the first case, we're looking at material costs. Okay, so material price. Okay, then we've also looked at labor rate. Okay, but we know that to get material cost, okay, we know that it's a quantity of material times unit price. That will give you material cost. For labor, we'll be looking at the rate of pay and the number of hours, okay, that the labor works in a day. Okay, great. So now let's look at material usage and labor efficiency. Now, to estimate the materials required to make each product, that's the material usage, and also the labor hours required, that's labor efficiency, technical specification must be prepared for each product by the production expert, either in the production department or the work study department. So they will try to look at, okay, the quantity of materials that may be used in the production of just a unit, and the number of hours that a labor will deploy, the number of hours that labor will use, okay, a labor or a staff will use in producing just a unit. Okay, good. Now let's talk about overheads. Good. Now, when standard costs are fully absorbed, standard production costs, that standard costs can be used in both marginal absorption processes, as we have indicated. The absorption rates of fixed production overheads will be predetermined and based on budgeted fixed production overhead and planned production volume. The production volume will depend on two factors, that is the production capacity, that's or the volume capacity, measured perhaps in standard hours of output. A standard hour being the amount of work achievable at standard efficiency levels in an hour, which in turn reflects direct production labor hours. Then we talk about efficiency of working by labor or machines, allowing for rest time and contingency allowances. Okay, good, because we know that even under our absorption costing, we do look at our predetermined overhead absorption rates. Okay, then based on the actual result, we multiply our overhead absorption rate by the actual hours or the actual production. Okay, by reference to the base of absorption. Okay, good. So overheads is another cost element, as you know, and so we can also set a predetermined overheads absorption rate. Okay, and then look at the actual overheads incurred and find out the variance. Okay, good. And we are saying when doing that, we look at the volume of production and the efficiency. So we have overheads capacity variance, or overheads expenditure variance, and overheads efficiency variance. Okay, so we'll be looking at various types. Good. Now let's look at sales price and margin. Now, standard selling price will depend on a number of factors, including the following: anticipated market demand, manufacturing costs, competing products, inflation estimate. So we are looking at factors that may influence, okay, setting a standard selling price. Okay, good. So you look at the anticipated market demand. It's very important. What is the market demand for our product? Okay, are there any competing products, or our product happens to be the only product? So therefore, customers cannot run away from our products. Okay, you can look at inflation. Okay, you can also look at the manufacturing cost that will incur in manufacturing the product. Good. Now, standard sales margin is the difference between the standard cost and the standard selling price. So the standard sales margin is the difference between standard cost and the standard selling price. Good. Now let's look at some types of standards. Now there are 4 types of standards. We have what is called ideal standard, attainable standard, current standard, and basic standard. Okay, good. So let's look at the meaning. Now we'll talk about an ideal standard. It is a standard which can be attained under perfect operating conditions. We say it is ideal because there will not be any wastage, there will not be any inefficiency, there will not be any idle time, and there will not be machine breakdowns. Okay, so an ideal standard simply is a standard which can be attained under the perfect operating conditions. Okay, and under that, okay, under the perfect operating condition, no wastages are expected, no inefficiencies are expected, no idle time is expected, and we do not expect machine to break down. So it's a standard that is attained under the most perfect operating conditions. Good. An attainable standard is a standard which can be attained if production is carried out efficiently, machines are properly operated, and all materials are properly used. Some allowance is made for wastage and inefficiencies. So we are saying that a standard is attainable if production is carried out efficiently, okay, and machines are operated properly, and all materials are properly used. Now, under the attainable standard, we are saying that we make an allowance for some wastages and inefficiencies. Okay, good. Under ideal, we say that it is a standard which is attainable and then the most perfect operating condition. Here, we do not consider, we do not want to have any wastage, we don't have to have any inefficiency, we do not expect to be any idle time or breakdowns. Okay, good. Then we have what is called the current standard. The current standard is a standard based on current working conditions. That is current wastage and current inefficiencies. So a current standard is based on the operating conditions as pertains as in now. Okay, so it's based on the current working condition. Good. Whereas we have what is called the basic standard. We say that it's a long-term standard which remains unchanged over the years, and it is used to show trends. So a basic standard is a long-term standard which remains unchanged over the years and is used to show trends. Okay, good. So these are the various types of standards. So in exam, they can be listed, or you can be asked to state and explain the various forms of standard or types of standard. So take note of them. Now let's look at the different types of standards. The different types of standards have a number of advantages and disadvantages. Okay, good. So when we talk about an ideal standards can be seen as long-term targets, but are not very useful for day-to-day control purposes. Okay, because it is rare that you may have a production process, or you may set a standard where there are no wastage, there are no inefficiencies. It's very rare. Okay, good. So you see that it can be seen as a long-term target because the business expects to perfect its operations. Okay. So it's a long-term standard, but are not very useful for day-to-day control purposes. Ideal standards cannot be achieved. If set standards are used for budgeting, an allowance will have to be included to make the budget realistic and attainable. Okay, good. Attainable standards can be used for product costing, cost control, inventory valuation, estimating, and as a basis for budgeting. Okay. Good, because we have made allowances for, because even when you set a predetermined standard, it's an estimated form that, oh, material will cost so much. What if in the time or when you want to actually undertake that, the price have changed? Obviously, there will be a variance. Okay, good. Current standard or attainable standards provide the best basis for budgeting. Okay, because they represent an achievable level of what? Productivity. Okay, so current standard or attainable standard provide the best basis for budgeting because they represent an achievable level of what? Productivity. Now, current standards do not attempt to improve on current levels of what? Efficiency. Okay, current standards do not attempt to improve on current levels of what? Efficiency. Current standards are useful during periods when inflation is high because they will be responsive to the current happenings. Okay, good. They can be set on a month-by-month basis. Okay, good. Basic standards are used to show changes in efficiency or performance over a long period of time. They are perhaps the least useful and least common type of standard what we use, which is the basic what standard. Good. Good. Now, the impact on an employee behavior of the type of standard what set. Now, we expect to know the impact on employee behavior of the type of standard that may be set. Okay, depending on the type of standard that will be set, how will employees what behave? Now, the type of standard set can have an impact on the behavior of the employees trying to achieve those what standards. Good. So we have what is called the ideal standard. Now, some say that they provide employees with incentive to be more efficient, even though it is highly unlikely that the standard will be achieved. Okay, because we said that ideal standard is a standard that is set under the most perfect operating conditions, where no allowance is made of wastages, inefficiencies, machine breakdowns, idle time, among others. Okay, good. So we are saying when an ideal standard is set, okay, it provides employees with an incentive to be more efficient, even though it is highly unlikely that the standard will be not achieved. Others argue that they are likely to have an unfavorable effect on employees' motivation because the difference between standard and actual results will always be what? Adverse. The employees may feel that the goals are unattainable, so they will not work so what? Hard. Okay, so in as much as it acts as a motivating or an incentive tool to employees, okay, again, others argue that they are likely to have an unfavorable effect on employee motivation because the difference between the standard and actual results will always be adverse. And employees may feel that the goals are not attainable, and so they will not work so hard. Okay, good. Attainable standard, say it might be an incentive to work harder as they provide a realistic but challenging target or efficiency. It might be an incentive to work harder as they provide a realistic but challenging target of efficiency. Okay, yes, even though there are some allowance for machine breakdowns among others, it helps put the employees on their toe because they work to make sure that they attain that or achieve that target. Okay, good. Current standard will not motivate employees to do anything more than they are currently doing. That's what it is, because the current standard based on current happenings. Okay, good. Basic standard may have an unfavorable impact on motivation of employees. Over time, they will discover that they are easily able to achieve the standard. They may become bored and lose interest in what they are doing if they have nothing to aim for. Okay, because it's very basic. Okay, good, good. So let's look at budget and standards compared. Is there any difference between a budget and a standard? Good. Now, budgets and standards are very similar and interrelated. Okay, they are very similar and they interrelate, but there are important differences between them. A budget is an overall plan, and a standard cost is a unit cost. Standard cost may be used for budgeting. Okay, good. You may use a standard cost to budget. Okay, so a budget is an overall plan, but when we are looking at a standard, we are looking at a unit. Okay, good. So standard cost may be used for budgeting. Once we know the standard cost of a unit, you can use the standard cost to budget for the number of products or the quantity of goods that we want to produce, or the overall budget for the company. Okay, budgets and standards are similar in the following ways. Now, they both involve looking into the future. They both involve looking to the future and forecasting what is likely to happen given a certain set of what circumstances. They are both used for control purposes. A budget aids control by setting financial targets or limits for a forthcoming period. Actual achievements or expenditures are then compared with the budgets, and action is taken to correct any variances where necessary. A standard also achieves control by comparison of actual results against a predetermined target. As well as being similar, budgets and standards are interrelated. For example, a standard unit production cost can act as the basis for a production cost budget. The unit cost is multiplied by the budgeted activity level to arrive at the budgeted expenditure on production cost. So there's a very thin line between a standard and a budget, and that is what has been explained. Okay, we use standard cost to budget. Okay, good. They all are used for control purposes. Okay, they are all used for control purposes and to also correct what any variances. Okay, good. So some differences between a budget and a standard. Good. Budget gives planned total aggregate cost for a function or a cost center. Budget gives a planned total aggregate cost for a function or a cost center. A standard cost shows the unit resource usage for a single task. For example, the standard labor hours for a single unit of production. 2, a budget can be prepared for all functions, even where output cannot be measured. Okay, a budget can be prepared for all functions, even where output cannot be measured. Standard costs limited to situations where repetitive actions are performed and output can be measured. A budget is expressed in money terms. A standard cost need not be expressed in money terms. For example, a standard rate of output does not need a financial value put on it. Okay, a standard need not be expressed in money terms. For example, a standard rate of production or output, a standard rate of output does not need a financial value put on it. Okay, good. So these are the similarities and difference between a budget and a standard. Okay, good. Now let's look at variance. Now, a variance is the difference between a planned, budgeted, or standard cost and the actual cost incurred. So variance may be seen as the difference between a planned activity or a budgeted activity or a standard cost and the actual cost incurred. The same comparison may be made for revenues. Okay, the same comparison can be made for revenues. The process by which the total difference between standard and actual results is analyzed is known as the variance analysis, as we have explained earlier. When actual results are better than expected results, we have a favorable variance. Okay, when actual results are better than the expected results, we have a favorable variance. If, on the other hand, actual results are worse than expected, we have an adverse variance. It's denoted by A. Favorable is denoted by F. Then variance can be divided into 3 main groupings. We have the variable cost variance, we have sales variance, and we have fixed production overhead variance. Okay, good. In the remainder of this chapter, we'll consider in detail the variable cost variance and fixed production overhead variance. Okay, good. So we know that we have variable cost variance, and variable cost, I'm talking about direct material, direct labor, and variable production overheads. Okay, good. And we'll talk about sales variance. Okay, then we have what is called So sales variance, we can have price variance and all those things. Okay. Then we have the fixed production variance, and say here our concentration is going to be on the variable cost variance and fixed production overhead variances. Good. So we have the first one is what is called the direct material cost variance. Is one of the variable cost variance. Because variable costs, we know that are those costs that vary with activity levels. And we know that direct material, depending on the quantity of goods that we want to produce, they vary. So material, labor, direct expenses, and variable overheads itself are the variable cost of variances. Okay, good. So we have what is called the direct material cost variance. And there are two causes of material cost variance. We have a difference in purchase price and a difference in quantity used. Okay, the material cost variance may vary from expected because the price at which we had predetermined to buy materials might have changed. Again, the quantity that we had planned to buy may have also changed. So a material cost variance may be caused by either a change in price or a change in the quantity used. The direct material total variance can be subdivided into the direct material price variance and direct material usage variance. We have direct material cost variance, and direct material cost variance is made up of direct material price variance and direct material usage variance. Okay, good. So we say the total, the direct material total variance is therefore between what they actually cost and what it should have cost. Okay, the variance between direct material total variance is the difference between what the actual output, what the output actually costs and what it should have cost. So we compare the actual cost against the standard cost. Okay, so we say that total variance is equal to material price variance plus material usage variance. Now, the direct material price variance is the difference between the standard cost and the actual cost. Okay, again, direct material price variance is the difference between the standard cost and the actual cost for the actual quantity of the materials used or purchased. In other words, it is the difference between what the direct material or what the material did cost and what it should have cost. Okay, good. So this is how we determine material price variance. Material price variance is the actual quantity at the actual price. Okay, minus actual quantity times standard price. Okay, so you can see that here, what is common is material actual quantity. Okay, so this can be factored as actual price minus standard price. Okay, times actual quantity. Good. Give me a second. Let me try and juxtapose the two so that we can have some formula work done here. So you're looking at the various types of variance. Okay, so we have the first one we looked at is the total direct material cost variance. And you're saying this is divided into direct material price variance. We have what is called the direct material usage variance. Okay, good. Okay, now if this is the case, now we are then looking at how to determine each one of this. Okay, good. And so material direct material price variance. Okay, we are saying it is equal to the actual price minus the standard what price measured at the what actual what quantity. Okay, because you're looking at price variance. What was the standard price? How much had we predetermined to buy a unit of material, and how much did we actually buy it? Okay, then we value it at the actual quantity of goods what purchased. That will give us the total variance. Okay, because we are looking at price. So the difference between the actual price and the standard price multiplied by the actual quantities of goods purchased, that will give us the variance. Good. You have what is called the direct material usage variance. The direct material usage variance. You're saying that this is the difference between the standard quantity of materials that should have been used for the number of units actually produced and the actual quantity of materials used, valued at the standard cost per unit of material. In other words, it's the difference between how much materials should have been used and how much material was used, valued at the standard cost. Okay, good. So again, when you expand this, if you do this by expansion, it means that we have actual price times actual quantity minus standard price times actual quantity. Okay, this is the long form. Okay, but this can be broken down simply. Okay, we can just factor this. Okay, so we have this and that. Okay, good. Standard actual price times actual quantity will give you the actual cost. Then the standard price times standard quantity will give you the standard cost of the what of the materials. Okay, good. So to find the variance, we are saying that find the difference between the actual price and the standard price at the actual quantity. Okay, good, good. Now for direct material usage variance, we are saying it is what the actual quantity times the standard price minus standard quantity, okay, times standard quantity times standard what price. So here, which is common, so we have actual quantity, okay, times standard price minus standard quantity times standard price. So price is common here. So what it means is that to factor this out, we have actual quantity minus standard quantity measured at what? The standard what? Price. Okay, good, good. So this is how we'll be able to determine the material usage what? Variance. So it's using the quantity of material. So what's the difference between the quantity of materials that we should have used as against the materials we actually what used? Okay, measured at the standard price. That will give us the material usage what? Variance. Okay, good, good. So what we are using here, I'm explaining. AP means actual price. AP means actual price. SP equals standard price. Okay, SP is equal to standard price. AQ is equal to actual quantity. Actual quantity. Okay, and SQ is equals to standard quantity. Good. Good. So that is the material usage variance. So we talk about the standard quantity is the amount of material that should have been used to produce the actual what output. Good. Direct material variance and opening and closing inventory. Okay, let's look at the effect. Now, direct material price variances are usually extracted at the time of receipt of materials rather than at the time of usage. So direct material price variances are usually extracted at the time of receipt of materials rather than at the time of usage. The most important thing to understand is that material price variance is calculated on the total of all the materials purchased in the period. It is important to note that, or to understand, that material price variance is calculated on the total of all the materials purchased in the period, whether they are used or not. Okay, good. This means that any inventory carried to the next period is carried at its standard cost. Note that the material usage variance is based on the quantity of materials used as before. Now, there are two main advantages in extracting the material price variance at the time of receipt. If variance are extracted at the time of receipt, they will be brought to the attention of managers earlier than if they are extracted as the materials is used. If it is necessary to correct any variances, then management action can be timely. Okay, good. Some variances are extracted at the time of receipt. Since variants are extracted at the time of receipt, all inventories will be valued at the standard price. This is administratively easier, and it means that all issues from inventory can be made at standard price. If inventories are held at actual cost, it is necessary to calculate a separate price variance on each batch as it is issued. Since issues are usually made in a number of small batches, this can be time-consuming task, especially with a manual system. Okay, good. So we say price variance is extracted at the time of receipt of what materials. Okay, good. That's something that's worthy of note. Good. Now let's look at labor variances. Labor variance. So we have direct labor cost variance and the direct labor cost variance. There are two causes of labor cost variance. We have the labor total variance. Is the difference between a difference in the rate paid and a difference in hours worked. Okay, good, good. So the direct labor, that's what is called direct labor total variance. Okay, and this is made up of direct labor rate variance. We have direct labor efficiency variance. So the rate variance talks about wage rate, okay, as in the rate paid per labor. Efficiency looks at the hours used. Okay, good. So what we are saying here is that the total labor variance is caused by rate variance plus efficiency variance. Okay, good. Now, direct labor rate variance. This is similar to direct material price variance. It is the difference between the standard cost and the actual cost for the actual number of hours paid for. In other words, it is the difference between what labor did cost and what it should have cost. Okay, good. So labor rate variance, direct labor rate variance is equals to actual hours. Actual hours is equals to AH, which is actual hours, okay, times actual rate minus actual hours times standard what rate. So you can see that actual hours is common. So this can be determined as AR minus SR multiplied by what? AH. So the difference between the actual rate, what labor rate actually costs the company and what it should have cost us, measured at the what? The actual what? Hours paid for. Good. Then we have what is called the direct labor efficiency variance. And that one, we look at what? The actual hours times standard rates minus standard hours times standard what? Rate. So you can see that rate, sorry. Good. Good. So here we have standard rates in common, right? So efficiency variance becomes actual hours minus standard hours at the standard what? Rate. Okay, good. So we're saying that it is similar to the direct material usage variance. It is the difference between the hours that should have been worked for the number of units actually produced and the actual number of hours worked, valued at the standard rate per hour. Alternatively, it's the difference between how many hours should have been worked and how many workers and how many hours were worked, valued at the standard what? Rate. Okay, it is the difference between how many hours should have been worked and how many hours were worked. Okay, good, good, good. So we look at actual hours minus standard hours times the standard what? Rate. Okay. The standard hours are the number of hours that should have been worked to produce the actual what? Output. Good, good. Then we have the variable production overhead variance. So in terms of the so we have material labor and variable production overheads. Okay, good. And these are the variable cost variances. The variable cost variances. Good. So let's look at the variable production overhead variances. Now, the variable production overhead total variance can be divided into variable production overhead expenditure variance and variable production overhead efficiency variance based on actual hours. So for variable production overheads variances. Okay, so the total variable production overheads variance is divided into variable expenditure variance and variable efficiency, variable production efficiency variance, variable production expenditure variance. Okay, variable production overheads expenditure variance, variable production overheads efficiency variance. Okay, good. And this is just like the labor variances. Okay, good. So if you pick the variable production overhead expenditure variance, we're saying that is equals to the actual hours times the actual rate minus actual hours times the standard rate. Okay, good. So here AH is common. So we have AR, actual rate minus standard rates times the actual hours. Okay, how much variable production overheads, okay, incurred as against what should have been. Okay, good. So that's the variable production overheads expenditure variance. And we have the variable production overheads efficiency variance, and that is equals to the actual hours times standard rates minus standard hours times standard rate. So you can see standard rate is common. So we get our AH minus SH valued at the standard rate. Okay, good. So they say if you already know the direct labor efficiency variance, the variable production overhead efficiency variance is exactly the same in hours, but priced at the variable production overhead rates per hour. Okay, good. So here they'll give you information on the variable production overhead rate per hour. Okay, good. So efficiency variance is actual hours times standard rate. And we're saying the standard hours are the number of hours that should have been worked to produce the actual output. Good. So these are the basic variances that we'll be looking at: the total material cost variance, total labor cost variance, and total variable production overhead variance, and its various components. Okay, so those are the variants that we'll be looking at this level. Now let's look at some of the reasons for cost variances. What some of the reasons for cost variances? Okay. One, we talk about the general causes. We have inappropriate standard. When you set an inappropriate standard, you may get a variance. Now, incorrect or out of date standards could have been used, which will not reflect current conditions. For example, a material price standard may have been wrong if an old price was used or the wrong type of material was priced. Okay, so incorrect or out of date standards could have been used, which would not reflect current conditions. For example, a material price standard may have been wrong if an old price was used or the wrong type of material was priced. Okay, good. Inaccurate recording of actual costs. Inaccurate recording of actual costs may also cause a variance. That is, if timesheets are filled in incorrectly, this may lead to variances. And can talk about random events. Examples include unusual adverse weather conditions or a flu pandemic. Okay, this may cause additional unforeseen costs. Okay, just as it's happening now, we have the coronavirus pandemic, which has caused so many havoc. Okay, or the economy is under serious threat because we are not experiencing productivity as we should, and all things have come to a halt. But thank God that things have improved and we are still going about normal duties. Okay, good. We have the operating inefficiency. Now, if variance is not caused by inappropriate standards, inaccurate recording, or random event, then it must be due to operating efficiency. The operating efficiency may be due to controllable and uncontrollable factors. Okay, good. So we also have some specific causes of cost variance. So we talk about the general, and we have the specific causes. Okay, good. We have the specific causes. For example, material price. What may be the reason why they may have a material price variance? Okay, we are talking about unforeseen discounts received, more care taken in purchasing, change in material standard. That will lead to a favorable variance, because if you get discounts, it means that you're going to buy the 10 material at a price lower than what you had planned. Okay, good. However, those that can cause an adverse variance is when there's a price increase, there's an inflation. So if the price that you have budgeted is 2 and now you're buying it at 2.5, it will cause a variance. Now, where there are careless purchasing, okay, you are not careful in purchasing, you just buy anything, okay, and maybe you don't take your time, so you may buy it at a price higher than. Then change in material standard. When there's a change in material standard, to lead to material price variance, because the change in material may come at a higher cost or at a lower cost. Okay, good. What of material usage variance? Now, material used of high quality than standard. So for a favorable standard, okay, there'll be a favorable material usage variance when the material use is of a higher quality than the standard. More effective use made of material, errors in allocating material to jobs. Okay, this may cause favorable variance. Now, adverse variance in material usage may be defective material. We didn't use the right type of material. The materials used were defective. And therefore, it may cause us to use more materials than needed. Excessive waste, theft, stricter quality control errors in allocating materials to jobs. These are things that may cause variance in material usage. Okay, so we talk about labor rate variance. Why would the rate paid labor be different from or the standard? Okay, why would the rate paid for labor differ from what you had planned to pay? So we are saying that the use of apprentices or other workers at a rate of pay lower than the standard. So maybe you happen to use the grade of labor that you use. Okay, good. Now, wage rate increases, like when there's inflation as well, okay, or labor unions agitate for pay rise, okay, that may cause the rates that you are planning to pay to be different from what you actually want paid. And when you tend to use high grade labor, but you use a high grade labor, you must pay them more, okay, or you tend to use more skilled labor that they had planned. Okay, good. So these are specific causes. Okay, good. These are specific causes. Great. Then we have the general causes. All right. Now, let's look at some exam type questions. How do we go about computing the variances? Okay, good. So let's look at this. So we have flour is one. Question 1, flour is one of the products of Flash CC Limited with the following standard cost and a budget of 100,000 units for production and sales for period 1. So for direct materials, okay, this is the standard cost. That's the cost for a unit of a product. Okay, good. So we have the direct material, and they have 0.05 kg at 100 per kg, 100 Ghana cedi per kg. That's the material cost. Okay, so it means that for a unit, to produce a unit, they will need 0.05 kg of material, and a kilogram of material costs 100 Ghana cedis. For direct labor, to work on this, a unit of the product of flour, we are saying that we need half an hour, and labor is paid 24 Ghana cedi per hour. Okay, good. For variable overheads, we are saying that we need 0.5 hours. That's 0.5 hours. And the rate of pay, okay, the amount that we will pay is 18 cedi per hour for the variable overheads. Now, we are saying the actual result for period 1 is as follows. Direct materials, the actual quantity purchased, that's the actual quantity, is 5,700 at a price of what? 105. Don't forget that we had planned the standard price of material was 100. The actual price at which we bought the material is 105. That is telling us something. For direct labor, okay, direct labor. Now you can see that they had planned to produce what 100,000 units, but the actual production was what 110 units. So for labor, the hours used is now 54,000 hours. 54,000 hours. Good. And the rate of pay is 20, but they are planned to pay 24 per hour, but actually they pay 20. Whereas for variable overheads, okay, now it's also required 0.5 hours. Okay, so the variable production overhead cost incurred is 860. It's 860 required. Calculate the following variances for product flour. 1, direct material price variance, direct material usage variance, labor rate variance, labor efficiency variance, variable production overhead expenditure variance, and variable overhead efficiency variance. Okay, good. So let's look at it. So we have flash. Good. The first one is for us to calculate material price variance. And we know that for material price variance, the formula is actual price minus standard price measured at actual quantity. Okay, good. So the actual price minus the standard price measured at the actual quantity. Good. Now from this question, what was our actual price? Our actual price. Now you can see that direct material cost, this is the actual result, and we bought a material at 105 per kg. So the actual price is 105. Okay, it's 105 per kg. What's our standard price? SP. Our standard price, we had planned to buy materials at 100 Ghana cedis per kg. So that's 100 Ghana cedis per kg. Good. And what is the actual quantity? What's the actual quantity of materials purchased? So HQ. Sorry, AQ. We have direct materials. We bought what? 5,700 kg. So the actual quantity of materials bought was 5,700 kg. Okay, good. Therefore, our material price variance will be equal to the actual price, which is 105, minus standard price, which is 100, measured at actual quantity, which is 5,700. Okay, good. So material price variance will be equal to, now you can see that now we bought the material at a price higher than the standard. Okay, so the difference between this and that will give us what? 5, which is an adverse variance because we bought the material at a price higher than what we had planned. So the actual is higher than the standard. So that gives us what? An adverse variance times the quantity, 5,700. So our material price variance will be equal to what? 5 times 5,700. That gives us 28,500 adverse. Okay, it's an adverse variance. I'm talking costs. So here it's equals to 28,500 adverse. Okay, good. The next thing for us to compute is our material usage variance, II. Material usage variance. Okay, now material usage variance. Material usage variance is equals to the actual quantity minus the standard quantity measured at what? The at the standard what? Price. Okay, so it's actual quantity minus standard quantity times the standard what? Price. Now from this question, what was our actual quantity? Our actual quantity is equals to 5,700 kg. What of our standard quantity? Good. Now this is how we calculate the standard. Good. Now per the standard cost card. Now direct materials, we are to use 0.05 kg. Okay, good. For a unit. Now we know that our actual production was 110,000 units. So if 110,000 units were produced, and if we should have used 0.05 kg per kilogram of material, then how many quantity of materials should we have used? So it is 110,000 units times 0.05 kg. Okay, good, because for a unit, you should use 0.5 kg. So if you have produced 110, how many kilograms of material should we have used? So it is 110,000 times 0.05. Okay, and that gives us 5,500 kg. So we should have used 5,500 kilograms of materials to produce the 110 units, but we ended up using what? 5,700 kg. Now our standard price is what? 100 Ghana cedi per kg. Okay, good. So let's see. Our material usage variance. Our material usage variance will be equals to R so I have the information over here. So material usage variance will be equals to the actual quantity, which is 5,700 kg, minus 5,500 kg, measured at the standard price of what? 100 Ghana cedis. Okay, good. So we actually use 5,700 when we should have used 5,000. So meaning there is a variance, an adverse variance. I've used more materials than required. So there's an adverse variance of 200 watts, 200 Ghana cedis, so 200 kg. We are going to measure it at 100 Ghana cedis. So what will be our variance? Now 200 times 100, so that should be as 20,000. Great. So we have 20,000 Ghana cedis address. Okay, good. So that's our material usage variance. Material usage variance. We have 20,000 address. Okay, good. The next for us to find is labor rate variance. So 3. Labor rate variance is equals to the actual rate minus the standard rate measured at actual hours. Okay, good. Now our actual rate, the actual rate of pay was, now direct labor hours used was 54,000 hours at 20 Ghana cedi per hour. So the actual rate is 20 cedi per hour. Then the standard rates, we had planned to pay 24 Ghana cedi per hour. So that is 24 Ghana cedi per hour. Then we look out for actual hours. Now, here we say that the actual activity, labor hours spent was 54,000 hours. So our actual hours is equal to 54,000 hours. Okay, so our labor rate variance is equals to AR, which is 20, minus SR, which is 24, at actual hours of what? 54,000. Okay, good. Now, we should have paid 24, but we ended up paying what, 20 cedi. So it means that we have been efficient, or we've been able to save some cost. Okay, we had planned to pay 24, but we ended up actually paying 20. So that is favorable. So we have 4F measured at 54,000 hours. Okay, good. So 54,000 times 4 gives us what? 216,000 what? Favorable. Okay, good. Now let's look at the next one, IV. We have to determine what? The labor efficiency. So labor efficiency variance. Labor efficiency variance is giving us actual hours minus standard hours measured at the standard rate. Okay, good. Now we already know our actual hours to be 54,000 hours. How do we get our standard hours? Good. Now, this is how we get our standard hours. Very important. So we make reference to the standard information. For the standard, we were to labor was to spend what? 0.5 hours on a unit. Now, if you have actually produced 110 units, how many hours should have been spent? So it is 0.5 hours times the actual production units. Okay, times the actual production units. So this gives us 0.5 times 110 units gives us 55,000 hours. So meaning that to produce 110 units, we should have used 55,000 hours. Okay, we should have used 55,000 hours, but we ended up using what? 54. Okay, good. So here, our labor efficiency variance, will be equals to actual of 54,000 minus 55,000 measured at a standard rate, right? Our standard rate was what? 24, measured at 24. So let me have my standard rate here. SR is equals to 24 Ghana cedi per hour. Good. So this times 24. So here we used 54 when we should have used 55. So we have been efficient, right? So the difference is 1,000 favorable at 24. So this gives us 1,000 times 24. And that gives us 24,000 favorable. Okay, good. Now let's look at our variable overhead expenditure variance. Variable overhead expenditure variance. looking at variable overheads variable overheads expenditure variance. Okay, that's equals to the standard rate minus the actual rate measured at the actual hours. Okay, good. Now, what is the standard rate? Now, our standard rate is equals to 18 Ghana cedis per hour. Okay, right? Our actual hours is equals to what? 54,000, right? Hours. Then the actual rate will be equals to, now you can see that the total variable overhead is 860. It's 860. Okay, then we know that the actual hours spent is 54,000 hours. So to get our standard, our actual rate, it is the 860,000. Okay, the variable overhead expenditure divided by the actual hours. That will give us our actual rate. Okay, that will give us our actual rate, and that is equals to 860,000 divided by 54,000, and that gives us 15.9259. Okay, so let me leave it at that. It recurs. Okay, good. So that gives us an actual rate. Good. All right. So to get our variable overhead expenditure variance, okay, variable overhead expenditure variance, now because our standard rate, which is 18, right, minus the actual rate, okay, actual rate, which is 15.9259, measured at actual hours of 54,000. Okay, good. So now 18 minus 15.98. So here we had planned to pay for variable overheads at a rate of 18, and we ended up paying something less. So this favorable. Okay, we have paid less. Good. So that will give us 2.0741. Okay, that will be favorable. F. Okay, that will be favorable. Times 54,000. Good. So this times 54,000, and that gives us a favorable variance of 112,000 F. Please note, when working like this, okay, when you have so many decimals, you can decide to work with all the decimals on your calculator while you maybe run the figures to 4. Okay, decimal place as we have done here. But as I use my calculator, I use all the decimals. Okay, but in writing, I cannot write all the decimals, so I'll run it to at least 4. Okay, good. 4 will approximate it to the nearest whole number. Okay, good. If 2, you may have some differences. Okay, so you try as much as possible to run it to at least 4, but use the raw figures on your calculator to do your computation. If you run it and use the running figures for the computation, you may have some differences. Okay, good. So that is variable overheads expenditure variance. Good. Now let's look at the variable overheads efficiency variance. That is VOEFFV. Okay, good. So the variable overheads efficiency variance is equals to the actual hours minus the standard hours measured at the standard rate. Okay, good. Great. So now we have AH already to be equal to 54,000. What's our standard hours? Our standard hours, now we produce 110 and we're required to use 0.5 hours. So 110,000 units times 0.5 hours. That gives us 55,000 hours. Our standard rate, our SR, is equals to 18 Ghana cedis per hour. Okay, good. Therefore, our variable overheads efficiency variance is equals to 54,000 minus 55,000. Okay, measured at the standard rate of 18. Okay, so this gives us favorable variance of 1,000 measured at 18. So 1,000 times 18, that gives us 18,000 Ghana cedis favorable. Okay, good. So this is how we go about the computation. Okay, so let's briefly go through what you have done so far. So first, we're asked to compute the material price variance. Okay, the material price variance. And we noted that material price variance is the difference between the actual price and the standard price measured at the actual quantity of goods purchased. Okay, so in the question, our actual price was 105 per kg, and our standard price per the standard information was 100 Ghana cedis per kg. So we find the difference between the actual price, that is the price at which we actually bought the goods, as against what we should have paid for it, or how much we should have paid for it. Okay, so you saw that once we have paid more, so if you have paid more for it, then it means that that's an indication that we have spent more. So that's an adverse variance. So 5A. Then we multiply it by the actual quantity. The actual quantity was given as a direct material, 5,700 kg. Okay, so that's the actual quantity purchased. So we multiply by it, then we got 28,500 adverse. Good. So material price, look at the difference between actual price and the standard price. For material usage variance, we are looking at how many quantity of materials did we actually use as against what we should have used, measured at the standard price. Okay, good. Now, our actual quantity used was 5,700. Okay, good. Then the standard quantity will be, now, how many kilograms of materials do we use in producing 1 unit? And so if you have produced 110,000 units, how many quantity of material should we have used? So that one, it is your unit requirement of material, which is 0.05 kg times the actual production unit, which is 110. So we saw that we should have used 5,500 kilograms of materials. So it is A kilo minus S kilo. So it is our actual quantities of 5,700 minus the standard, which is 5,500. So what it means is that, again, we have used more materials than were required. Per the standard information, okay, we should have used 5,500 kilograms of materials to produce the 110,000 units, but we ended up using 5,700. So it means that we have used more materials, and that's an indication of what? A deficiency. So it's an adverse variance. Okay, good. And we also looked at the labor rate variance. Labor rate variance. The labor rate variance looks at what the rates we actually paid for labor as against what we should have paid. Okay, so from our question again, for labor, we were to pay 24 Ghana cedis per hour. But when you look at the actual information, the direct labor hours or the direct labor rate paid was 20. So if you should have paid 24, you have paid 20, it means that you have been efficient. You have been able to beat down the rates. Okay, so that gives us a favorable variance of 4. And that is measured at the actual hours that we use to produce the product. Okay, so we say that the labor rate variance is the difference between the actual rates and the standard rate measured at the actual hours of work. Good, great. So this is how we went about it. And we also looked at the labor efficiency. Labor efficiency looks at the actual hours we used as against what we should have used. Okay, good. So from the question, we can see that for the 110,000 units of goods produced, the total hours was what? 54,000. Now, what should we have used? Now, we were told that by the standard information for a unit of product, we used 0.5 hours. So if you have produced 110, how many hours should we have used? So the 110,000 times 0.5, that should give us 55,000. So it means that we should have used 55,000 hours to produce the 110 units, but we ended up using 54, which is an indication of efficiency. So it's a favorable variance. We've been able to beat down the number of hours. So it's favorable. So that's why we have 54,000 minus 55 times 24. So the difference gives us a favorable variance. That's why we have the F there times 24. That gives us the total labor efficiency variance. Okay, good. So this is how we go about it. Now let's take the next question. Now we have what is called Cophorobia produces. Cophorobia. We say Cophorobia produces Cophorobia produces a product that's telescope. The actual results for the period were 430 units made. So the production unit was 430. Materials, we have 1,075 kg were used. Then 1,200 kg of materials were purchased at a cost of 17,700. Direct labor, we have 1,700 hours were worked at a cost of 14,637. Variable production overheads expenditure was 3,870. Now the standard cost card for the product is as follows. Direct material, we need 2 kilograms of materials at 15 cedi. So that's 30 Ghana cedis. For direct labor, to produce a unit, we need 4 hours. 4 hours will be spent to produce a unit, and the rate of pay is 8 cedi 50 pesos, giving us a labor cost of 34. For variable overheads, we also need labor hours of hours of 4, and we will pay 2 cedi per the variable overhead cost, giving us a total variable overhead cost of 8 cedis per unit. The standard cost card is based on production and sale of 450 units. The standard or the cost card is based on production and sales of 450 units in each period. Okay, so the company values its inventories at standard cost required. Calculate the following variances for Cophorobia. We have the material price variance, material usage variance, labor rate variance, labor efficiency variance, variable overhead expenditure variance, and variable overhead efficiency variance. Okay, so let's quickly look at this. So we have Cophorobia. Good. So the first thing is what? Calculate the material price variance. Now, no, material price variance is the actual price minus the standard price measured at the actual quantity purchased. Okay, good. So now our AP, our actual price here, they say that 1,000. So here the actual resource was given us and the standard is down. So to get our actual price, we have to look at the total cost of material purchased. Okay, so say 1,200 kg of materials were purchased at a cost of 17,700. Okay, good. So to get our actual price, it's the total cost of materials purchased, which is 17,700. Okay, divided by the quantity of material purchased, is 1,200. So that gives us what? Now 17,700 divided by 1,200. That gives us 14.75. So that's our actual price. What of our standard price? Now, if you come to the standard cost card, the right material is 2 kg for a unit of production. You spend 2 kilograms of material, and the price at which you will buy the material is what? 15 cedi. So the standard price is 15 Ghana cedis. Okay. It's 15 Ghana cedis. Good, good. So now our material price variance. Now what's our actual quantity? The actual quantity of materials purchased is what? 1,200 kg. So our material price variance is equals to the actual price, which is 14.75, minus the standard price, which is 15 Ghana cedis, at the actual quantity of materials purchased, which is 1,200. Okay, good. So now we had planned to buy the materials for 15, and we actually bought it for 14.5. We have been able to reduce what? Cost. Okay, so 14.75 minus 15. So we have 0.25 favorable. Okay, multiplied by 1,200. So that gives us 1,200. That gives us what? 300 Ghana cedis what? Favorable. 300 Ghana cedis what? Favorable. Good. Good. The next is for us to determine the what? The material usage. Material usage variance. Now, material usage variance is equals to the actual quantity minus the standard quantity measured at the standard rate. Okay. Sorry. Standard rate is the standard price. The standard price. Sorry. Good. So the actual quantity minus standard measured at what? The standard price. So here the actual quantity. Okay, what's the actual quantity of materials used minus the standard quantity? Okay, good. So now our AQ, which is actual quantity of materials, we were told that materials 1,075 kg were used. So that becomes our actual quantity, okay, of materials used. So AQ is 1,075. Our standard quantity, that is, we're required to use 2 kilograms of materials to produce a unit. Now, we produce 430. So how many quantity of material should we have used? So that becomes our 2 kg times 430 units. So 2 times 430, that gives us 860 kilograms. So for the 430 unit of goods produced, we should have used 860 kilograms of materials. But what did we actually use? We used 1,075. Therefore, our material usage variance is equals to 1,075 minus 860 at the standard price. What's the standard price? The standard price of materials is 15. It's 15 Ghana cedis. 15 Ghana cedis. Good. So if we should have used 860 and we have used 1,075. Is it a favorable or adverse? We have used more, meaning that we're not efficient in the usage of materials. Okay, so that gives us an adverse variance. 1075 minus 860 gives me 215 adverse. Okay, at 15 cedis. So 215 times 15, that gives me 3,225. Okay, good. So we have 3,225 watts adverse. Okay, good. Good. Now, the next is for us to determine the labor rate, that is C. Labor rate variance. Now, labor rate variance is the difference between the actual rate, minus the standard rate measured at the actual hours. Okay, so AR, that's the actual rate. The actual rate paid. We said direct labor 17,000 hours were worked at a cost of this. So actual rate will be 14,637 divided by 1,700 hours. So that gives us 14,637 divided by 1,700. That gives us 8.61. Then the standard rate. The labor, we use 4 hours at a price, so the standard rate was 8 cedis 50 pesos. Good. Then we know our actual hours to be equal to what? 1,700 hours. So our labor rate variance will be equal to AR, which is 8.61, minus SR, which is 8.5, times AH, is actual hours of 1,700. Good. So here we are planned to pay 8.5 for labor, for a rate, pay labor pay a rate of 8 cedi 50 pesos per hour. Then we ended up paying 8 cedi 61 pesos. So that is an adverse variance. We have paid more. Okay, we have paid more. So that gives us 0.11 adverse at 1,700. So that gives us 187 watts adverse. Okay, good. Then D, we have to determine the labor efficiency variance. Labor efficiency variance is the difference between actual hours minus the standard hours measured at the standard rate. So we know AH to be 1,700 hours. SH is equals to now SH. We have to determine SH. Now labor were required to use 4 hours to produce a unit. So if you actually produce 430 units, how many hours should we have used? So 430 units times 4 hours. And that gives us 430 times 4. That gives us 1,720 hours. Okay, good. So therefore, we know our SR already to be equals to 8.61. Our labor efficiency variance will be equals to AH, which is 1,700 minus 1,720 measured at 8.61. Okay, good. So we should have used 1,720, have used 1,007, meaning that we have been efficient in the usage of labor. Okay, we spent less hours. Okay, good. So that gives us 20 favorable measured at 8.61. So 20 times 8.61, that gives us 172.2 favorable. Okay. Good. Oh, sorry. SR is 850. Is AR is, oh, sorry. You should give us, sorry, measured at 8.5 instead. Okay. Sorry. 5.0. Okay. So 20 times 8.5. That gives us 170 favorable. Good. Now the next is for us to determine the what? The variable overhead expenditure variance. Good. So variable overhead expenditure variance, that is VOEX variance, is equals to the actual rate minus the standard rate measured at the actual hours. Okay, good. So here, let's look at actual rate. Now, actual rate will be equals to, now we're told that variable production over expenditure is what? 3,870. Okay, now we know that during the period, what was the total labor hours worked? It was 1,700 hours. So to get our actual rate for variable overheads, it is the 3,870 divided by the 1,700 hours. Okay, good. So 3,870 divided by 1,700. That gives us 2 CD 27.65. Okay, good to 4 decimal places. Now our SR, our standard rate, we see that it is what? 2 CDs. Okay, good. Then our actual hours we know is 1,700. Therefore, our variable overhead expenditure variance is equals to AR, which is 2.2765 minus 2 at 1,700. Good. Now I'm working with the raw figures on my calculator. That is the 3,870 divided by 1,700. Okay. So this minus 2. So we should have used 2 and ended up using 2 point something. So we have paid more. So that's an adverse. So we have 0.2765 adverse measured at 1,700. Okay. So this times 1,700. So I get 470 adverse. I get 470 adverse. Good. Good. Then the next was for us to find the what? The variable overheads efficiency variance. Okay, which is VOEFF3, which is the actual hours minus the standard hours measured at the standard rate. So we already know our actual is 1,700. Our standard hours is equals to, now we are planning to use 4 hours to produce a unit, and we produce 430 units. Okay, so that times the standard hours, which is 4 hours. So 430 times 4 gives us the total hours of 1,720 hours. Okay, good. Now we know our standard variable overheads rate, which is 2 CD. Which is 2 CD. Okay, good. So to find our variable overheads efficiency variance, it's equals to the standard actual of 1,700 minus 1,720 at the standard rate of what? 2. So now that gives us an adverse variance of 20, measured out of 2 CD. Okay, because we had, sorry, that's favorable. We had planned to use 1,720, but we ended up using 1,700. That's favorable. Okay, good. So that gives us a favorable variance of what? 40. 40. Good. Good. So this is how we go about variance what? Analysis. Okay, so the standard information will be given and actual information will be given. So you need to find the variance between the standard and the what? The actual response. Okay, good. In some exam questions, you can be asked to explain what may cause the variance, as we learned earlier. Okay, good. So I challenge you to keep on doing your best. Look at other questions. I'll share the lecture notes with you. There'll be more questions in there. Try your hands on it and solve more questions. Now, if you are challenged anyway in our interactive session, feel free to bring it up. Also, in your studies, private study, if you have any challenge, you can contact me and resolve whatever issue that you may have. Okay, great. So do enjoy the rest of the day. Okay, till we meet again.